Good morning from London. I'm Anna Edwards alongside Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. The Santa rally marches on. The S&P hits a record and gold breaks through 4,500 for the first time. Markets on both sides of the Atlantic close early today. Blowout GDP in the USA. American growth crushes estimates in the third quarter with its fastest reading in 2 years. Plus, the South Korean won jumps as much as 2% after the government flags its determination to support the currency.
Merry Christmas Eve, Anna. And it looks like Santa's already been for these markets. As you say, we had fresh records on both the S&P and gold yesterday. Futures pointing a touch lower on both sides of the Atlantic this morning. We've got German and Swiss markets closed notably, but gold holding on to its gains as we are in the session. The countdown to the opening trade starts right now.
Good morning, everybody. Oh, there you go. There's Lizzie. I'm Anna.
I think I did it without moving my lips.
That was incredible. Well, either of us will do, because all we're here to say is we hope you're enjoying the countdown to the festive period as much as we are.
Hooray.
It is 1 minute past 7 here in London. There is still, Lizzie, plenty of market news to talk about. A lot of markets are closed, though, here in Europe. So we'll get to that a little bit later on in the programme. But shall we start with some of the market news flow that we've had around global equities? Let's start with the S&P. Let's start with the strength. Another new record on the S&P, another new record on gold, another new record on silver. As you said, the Santa rally really continues to deliver. Yeah,
the S&P up for a fourth straight day yesterday. It was a slim session. You would expect these sort of thin volumes at this time of year, and it was concentrated in tech. But scores on the doors, a record's a record.
Yeah.
Gold as well, above $4,500 a troy ounce. And as you say, it's not just gold. You've also got silver and platinum in there as well. All of this really on the escalating Venezuela geopolitical tensions, but also the bets on Fed cuts. Now, we can dive into the eco data in just a moment, but looking back at some of these precious metals across 2025, gold more than 70% up this year, silver more than 150%, and it's been the best annual performance for both since 1979.
Yeah, and we're not even there yet, are we? We're not quite at the end of the year. We do seem to be partying like it's 1979, absolutely. But in terms of the market, the stock market and where we go here, there's the sort of short-term and long-term perspective. As we've said, the Santa rally seems to be in place. Apparently, there is an official definition of the Santa rally, and it doesn't actually start until today and goes to early January, which I was surprised to hear. We've been front-running that somewhat this week. But if you take the official start, then if you look at the average returns of the S&P since 1950, then they have actually returned 1.3% over that period. So perhaps we don't shut up our books just yet for this year. But what happens next year on stocks? We get so many positive perspectives on stocks around this desk, don't we? And we are certainly hearing a lot of those into 2026. But on the Markets Live blog, they're pointing out that if you've gone up for 3 years, it is hard to do that for a fourth year. So that's certainly something we keep in mind. And we will come to that chart on jobs shortly.
Yeah, well, we've had more eco data out of the US yesterday. The US economy expanding in the third quarter at the fastest pace in 2 years. So it comes down to a resilient consumer, also business spending and calmer trade policies as well. But if you look ahead to Q4, maybe you don't see it holding up as well, given that, of course, you had the government shutdown, which is why we've had so much delayed data. And then, though, if you look even beyond that, you could get a bit of a modest rebound because of the tax refunds, maybe the Supreme Court striking down Trump's tariffs. But it comes back to that conversation that we were having yesterday. If you don't have the tariffs, can you have the tax refunds? Because how do you fund the tariff, the taxes without the
That's
tariffs?
certainly something, an order of business that has not been resolved in 2025, isn't it? Something we might have to wait till 2026 to talk about, it seems. So we've got the strong GDP, incredible GDP numbers coming through. The Conference Board consumer confidence number not as strong. And actually, that chart that we just showed, let's put that up, because actually I think this is quite interesting. There's a Conference Board assessment of the job situation where they ask people how positive or negative are you feeling about the job story in the United States. And from that, you get a quite negative reading. It's been negative for quite a while, despite the fact stocks have done well, PEs have been doing well, so profitability is there, but job sentiment is shaky. And that seems to be something interesting to watch with AI I was going to say lingering, but not even lingering in the sidelines, you know, very much front and centre. We certainly need to watch that as we go into 2026.
Well, the President was doing his best to try and change the sentiment yesterday. He had that Christmas message for markets, basically complaining that it's bad news that seems to be good for the markets and good news economically doesn't seem to be welcomed because of the transmission through the expectations for Fed cuts. So he wants it to be as simple as good news is good news for markets. And then you had Scott Bessent, the Treasury Secretary, weighing in, him saying that, you know, maybe once we get to 2% as the target for inflation, then we can start thinking about more of a range. But we can't do it before that because otherwise we might lose credibility.
Right, yeah, exactly. Need to re-anchor around 2% first before they do that. Now, we've seen quite a lot of volatility in FX markets. We've talked a lot about the yen last week and this week, Lizzie. Today it's the turn of the South Korean won. And I do think this has some global takeaways, so I think it's interesting. The won up by nearly 2% or at 2% at some stage of the trading day. The Finance Ministry pushing back against weakness, saying that the markets will soon see the government's strong determination to tackle the weakness. And there's some interesting psychological levels involved here. If the won slips below 1,500 to the dollar, that is a level they haven't been through since the GFC. They went through it during the Asian financial crisis. So this is not territory, not comparisons you perhaps want to be making as a government. And what is also really interesting here is what has been driving this. And part of the weakness has been to do with retail and institutional investors in South Korea piling into the AI trade over in the United States and all the capex in the States, taking it away from other parts of the world.
Well, yeah, we've talked about going back to the 90s. Part of the reason that Korean domestic investors don't want to buy home stocks is because of the Asian financial crisis. They're so scarred by that experience that they're looking for opportunities in the States. But the officials do not want to openly be blaming Korean investors. That's
right, not the retail sort, at least. And if you look at the Kospi, actually up by more than 70% year to date, the S&P 17.5. So I'll just say that in terms of the allocation to those two equity markets. Let's tell you what's coming up on the programme then. A lot of guest conversations still to fit in this year. So YOGI DEWAN joins us, CEO of HASSIUM Asset Management. ALEXANDRA IVANOVA, fixed income fund manager at INVESCO. ALTAF KASSAM will be with us, European head of investment strategy and research at State Street Investment Management. And Stephen Major joins us because who doesn't like talking about steeper yield curves on Christmas Eve? Global macro advisor at Tradition Dubai. He's back in London and great time to catch up with him.
Well, we certainly like talking about them. We also have plenty of eco data still on the docket. At 12 p.m. London time, we get US MBA mortgage data, followed at 1:30 p.m. by US jobless claims. We do have an early close, though, for some US and European markets because, of course, it's Christmas Eve.
It is Christmas Eve, so it's almost easier to talk about the markets that are open. I mean, broadly speaking, in Europe, the further west you go, the more likely they are to be open, and the further east, the more likely they are to be closed. So in Europe, we have early closes, but open this morning for markets in Belgium, France, Ireland, the Netherlands, Portugal and Spain. But we're closed across loads of Northern Europe, Eastern Europe, as I mentioned, Switzerland included in that, Germany included in that. So we have no trading in those particular markets today. And early closes, as you say, for US markets, UK markets. Here in the UK, cash stocks and gilts close at 12:30 UK time. There you are. You're all caught up.
Very good. I should try and remember that when we get to the open, Anna. But here's what else you need to know this morning. A federal judge has ruled that the Trump administration can go ahead with imposing a $100,000 fee on new H-1B visa applications. The decision is a setback for US tech companies that rely on hiring skilled foreign workers. The judge said that the move is lawful, but the US Chamber of Commerce, which sued to block the proposal, can appeal. Elsewhere, BP is said to be nearing an agreement to sell a majority stake in its Castrol unit to the investment firm Stonepeak Partners. The Wall Street Journal says that BP would get about $6 billion for a 65% stake in the lubricants business. Former CEO Murray Auchincloss told Bloomberg last month that BP is planning to divest $20 billion of assets by the end of 2027 to improve its balance sheet. The move comes as Meg O'Neill prepares to take the helm of the oil major in April. And the Trump administration has imposed visa sanctions on former EU Commissioner Thierry Breton and 4 other people for trying to make American tech companies police political speech. In a post on X, Breton responded that the European law was voted in with broad-based support, writing, quote, "To our American friends, censorship isn't where you think it is." The State Department also targeted activists and non-profits focused on the digital hate speech and countering extremism. So those tough words on flying in both directions between the US and EU. I kind of have to wonder whether this is a US measure aimed at a domestic audience, because of course it harks back to J.D. Vance's speech at the Munich Security Conference about Europe and really pressing on that fault line of, you don't have free speech in Europe, which goes down well at home.
Right, well, maybe for a domestic audience, but certainly with an international impact, isn't it? And certainly echoed in that national security strategy we saw from the United States very recently. And I wondered if that's the lens you need to view this through, because if they are in favour of leaning into the populist movements within Europe, then maybe enabling them to have bigger voices on social media platforms is one of the ways that they see that happening. So we'll certainly keep that in mind. Just going back to the BP story that you just mentioned there, Lizzie, and just at the top of, just in the last few minutes, in fact, we've had confirmation of the deal. So this is no longer just being reported by the media. This is confirmation from BP. It's agreed to sell a 65% shareholding in Castrol to Stonepeak at an enterprise value of $10 billion. They've reached that agreement. Total net proceeds around $6 billion, including accelerated dividend payments, will be fully utilised to reduce net debt, according to that business, which has been trying to do all these asset sales under pressure from an activist investor and about to pivot to a new CEO, as we know. Coming up on the programme, we will check on Sanofi's shares at the European market open after the drug maker announced a new acquisition for that business. So still time for some deals news, it would seem, in 2025. Plus, France adopts a stopgap bill and avoids a shutdown. We will bring you the latest on Paris politics and bonds. Up next, back to markets. We'll talk about the Santa rally, metals, central banks, much more. If you want to get involved in any of these conversations on Christmas Eve or any other day, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
A very good morning. Welcome back to the opening trade. We're 46 minutes away from the start of the cash session, and we've got futures, as you can see, pointing lower here in Europe. Notably, the Swiss and German markets are already on holiday for Christmas, and we've got early closes for other markets as well. But we also have US futures pointing south this morning. S&P E-minis down about 0.1%, Anna. OK,
let's talk about the broader climate for stocks then, Lizzie. The S&P 500 closed at an all-time high on Tuesday after quarterly GDP data showed the US economy expanding at the fastest pace in 2 years, denting expectations for Fed rate cuts next year, but still powering stocks. For more on this and wider markets, YOGI DEWAN joins us, CEO of HASSIUM Asset Management. YOGI, very nice to have you with us. Festive greetings to you on the 24th of December. So you're expecting... So we saw stocks respond strongly, actually, to strong data, or, well, respond well, at least, to strong data at the United States yesterday. This is what President Trump wants to see restored, isn't it? He wants stocks to go higher on good data rather than an expectation of rate cuts. What did you read into the GDP data and the strength of it yesterday?
The GDP data was a surprise and much stronger than everybody expected. We were hovering around 2.1%. The numbers are much, much better. This will cause inflation. I think this is a situation which might be interesting into Q1 next year. We expect to see some volatility. We expect to see markets just pause, take a breather. You've got to remember, markets in the US, the S&P 500 has done about 18% year to date, and looks like it's going to trickle even higher towards year end. That's a phenomenal year. If you look at valuations, they are very stretched. When you look at forward PEs now, we're up at 25, 26. The long-term average over the last 10 years is only 19. So we really are in a territory where you start to see investors get a bit anxious about where valuations are, and hence you're seeing rotation into regions like Europe and the UK. OK,
so that gives us an idea of where some of the risks, to your view, are. But you do expect stocks to still have a good start to 2026, I think, or at least the first quarter. But you describe it as a quarter of consolidation.
Correct.
How positive or net? What's the range for consolidation?
I think markets will stay range-bound in Q1. If you actually look at what's going on in the US, you look at valuations, you look at earnings, and earnings is really key. Earnings for calendar year 2026. 15% earnings growth, 7 to 8% revenue growth. These are really good numbers. So the big issue now is really the employment picture, consumer spending in the US, and how that will impact on these earnings numbers going forward. Obviously, you've got a lot of talk around AI. You've got a lot of talk around how names like NVIDIA and the Mag 7 are doing. If you look at what's happened, if you look at the S&P 493, it's up around 15%. If you look at the Mag 7, that's probably up closer to 20 to 22% in terms of how they perform this year. That narrative will probably continue. However, AI spending, is that sustainable?
Yeah.
The competitive environment, will that intensify, and how will that impact on earnings going forward? You'd like to see the rally being broader than it actually is at the moment, and I suspect that's what will happen into Q1 and the rest of 2026.
Well, Yogi, you say that the GDP numbers suggest there'll be more inflation in the US. Is that a problem that we could see in Europe as well, that we're kind of underestimating? I know you talk about maybe more opportunity here in Europe and in the UK, but what if we see inflation back here, this side of the pond next year?
I think inflation is a concern, and it's one of the risks that we highlight in 2026. Inflation suggests rates won't be cut as aggressively as everybody thinks, which means rates are higher for longer, and that will impact on spending and that will impact on earnings. So inflation is not great news. A lot of the bad news around tariffs is already priced in. The rotation we're seeing into Europe and the UK, that's a positive, but it's hard to see how sustainable that is with the inflation picture that you've suggested. At the moment, it's all being driven by momentum and rotation.
Really, is it priced in, the trade risk? Because I was speaking to a guest earlier this morning, if you can believe I was up that early, but saying, you know, we could have another April 2025 moment again. What if you have US-China relations deteriorating again in 2026? What happens to stocks?
It will certainly have an impact on financial markets and equity markets in particular. But the thing to remember about these trade tensions between the US and China is that I think they're going to be quite muted because of the supply chain impact on rare metals and what's going on. The reciprocal trade tariff war won't play out in the way everybody thinks. So our sense is this is less of a risk than you might think. Its impact on earnings will be meaningful if it does come through the system, but we're actually not as concerned as you might be.
We've talked a bit about inflation. I want to linger on that for just a moment, Yogi, because are you surprised that we haven't seen more of a pickup in inflation given the tariff narrative? That was every economist's worst fear, wasn't it? And it's either not happened or been delayed or been taken on margin by businesses, or maybe it's there but very small and only in goods, which is a smaller part of the economy. I mean, what's your takeaway, really, from the way that the tariff story has played out into inflation?
Yeah, it's really interesting. You listen to narrative, and some people say inflation's high, and some people say inflation's actually low, and it leads to a lot of confusion in the marketplace. I would say that inflation should have been higher than is actually being reported at the moment, and we should pay very close attention to it. The worry about inflation is the rate cut narrative and whether that actually takes place, and that spills through into the impact on the dollar. You know, the dollar is roughly 25% undervalued from a euro perspective, undervalued from a euro perspective, and about 9% undervalued from a sterling perspective. The idea now is that the dollar should start to strengthen, and it probably will if you aren't going to get the rate cuts that everybody expects. But for the moment, we're seeing dollar strength at the moment, which is suggesting that that's likely to be the narrative going forward.
But what if those Fed cuts don't materialise? What if you have a scenario where Jay Powell tries to hold back the rest of the FOMC, knowing that maybe his replacement's going to be more dovish than he is?
That is definitely a likely scenario going forward. He has held off and held off and held off. Whoever gets appointed will likely cut rates, rightly or wrongly so. You'll start to get inflation. The question is whether the two rate cuts in 2026 that are priced in are actually going to take place. Our sense is they probably won't take place in the way the market is expecting. We'd anticipate maybe one rate cut, and then see what happens with the inflation data. And then the earnings picture needs to kick in, and you need to start to get an understanding of how that will impact on the inflationary environment too.
So positive on stocks, but clearly with some risks around, ranging from inflation to valuations around US stocks. So let's go a little more global, thinking about other areas, other geographies. China is one that stands out to me in your notes. Yesterday we spoke to a guest who was saying that they were actually really impressed by the anti-involution policies in China, so trying to take out overcapacity, which has led to so much deflation, exported deflation in some cases in China. Does that give you reason to be more positive about Chinese stocks? They might be more profitable as a result.
Yeah, no, absolutely. China is a region where we are long-term positive, and you have to be. You know, it's an $18 trillion economy. The US is the only bigger economy at $29 trillion. The China story is both domestic and export-led. If you look at the yuan, it's massively undervalued. which will support the export market. If you look at the domestic story, it's one around fiscal spending, which is a positive. So it's hard not to be positive about China. And again, it's had a 20% plus year in terms of equity market performance. It got off to a rocky start because of trade tariff concerns, but those trade tariff concerns are less likely to play out in the way that markets thought earlier on because of the position China is in with rare earth metals and its impact on supply chain. The reciprocal trade tariff narrative won't play out in the way everyone expects.
It's interesting you say that, because I'm just looking at a story that we wrote up on Citi downgrading China stocks, but actually lifting Taiwan because of AI and earnings there. It's interesting that you're actually the opposite way round on China. I wonder if you have strong feelings about Taiwan and how you would respond to their concerns about the AI supply chains when it comes to China.
Yeah, so Taiwan's interesting. It's basically Taiwan Semiconductor. Yeah. That's basically the name that drives it, and that's a big, massive AI play. It's a tier 2 name within the AI spectrum, but it's one where you would want exposure. So I wouldn't really look at Taiwan as a marketplace compared to China because it's just literally one name. If you look at China, the narrative and growth is funded by fiscal spending. The fiscal spending narrative in China is a robust one. They're spending a lot on infrastructure. They're spending a lot on AI and technology. The companies are doing well. They're exporting this out because of a weaker yuan. It's hard to be negative about China. So I wouldn't agree with the sentiment of that report.
Well, it's interesting as well where you say about the yuan being undervalued. It's one of the strong calls that we had from Goldman, right? And we had Kamakshir Trivedi on the programme about this. How much growth, how much of a lift would you expect then in the yuan in response if there is going to be a pushback in 2026? I
think it's more driven by what happens to the US dollar, and it's more driven by the rate cut sentiment in the US that will dictate what happens to the yuan and will dictate what happens to the euro and sterling and the yen also. The yuan, the Goldman report talks about a 30% undervaluation. That's a huge number. So you would expect to see that slowly correct itself, but I think the narrative and the momentum is going to come from the US.
OK. We haven't talked as much about Europe, so let's go there, Yogi. I mean, can we look at... it seems as if we might be running out of time, probably running out of time for some kind of peace deal before Christmas, as President Trump had wanted to be able to announce. What kind of positivity, though, would that unleash for European equity markets? What kind of peace dividend would we expect to see priced in instantly if we did see some kind of peace deal? Or would it depend on some of the small print?
It would be a relief rally. It would be momentum-led, not fundamentally led. Its impact on European equity markets and earnings will be quite minimal. If you take the defence sector, which is the sector that's rallied, it's only 4% of the FTSE 100. If you look at financial services and banking, which is the real driver of what we've seen in terms of rotation into Europe and the UK, that's 24% of the European index. So relief rally, it would be really good to see from a humanitarian perspective. Its impact on earnings will be quite minimal.
And what about inflation impact? I mean, obviously, when this started, there was a big pickup in inflation on the back of oil prices, but not necessarily expecting it to have the same impact on the other side if we saw an end to the fighting.
Yeah.
Because a lot of the Russian reliance has been got rid of.
Yeah, no, absolutely. Again, I don't think it's even an inflation narrative. The war is unlikely to impact on earnings. It's unlikely to impact on inflation. It's momentum-led. It's a relief. Everyone will be very positive about it. One of the real positives about Europe is the collaboration between all of Europe going forward. But what's driven European markets to 20% plus type returns this year has just been the rotation out of mega cap in the US, where valuations are so high.
OK. Yogi, great to see you. Thank you so much for coming in on Christmas Eve. Yogi DEWAN, CEO of HASSIUM Asset Management. Well, coming up on the programme, the French National Assembly has approved a stopgap budget law for next year. We'll get you all the details next. This is Bloomberg. Minutes from the start of the opening trade, and we have futures pointing a touch lower on both sides of the Atlantic this morning. Notably, we have Swiss and German markets closed, hence why we're not showing you the DAX futures, but the underperformance set to come from London this morning. FTSE futures down 0.2%. Let's
have a quick look at where we are on bond markets then, and of course we've had some political news continuing out of France, which we'll get to in a moment. What impact? There hasn't had a huge amount of impact on spreads for France, and indeed bond markets this morning looking fairly relaxed, would we say, about what's happening. So for the French 10-year yield, 3.56%, Germany at 2.86 right now. Let's get an update, though, on the French politics, because the French National Assembly has approved a stopgap budget law for 2026 to keep the state running into January after lawmakers failed to reach an agreement on the full fiscal plan. For more, we're joined by Jean Dalbar, who's economist at Bloomberg Economics, for a bit of a briefing. Jean, very nice to have you with us. So, is it right to think of this as a short-term fix then? Lawmakers are going to have to go back to these discussions, resume these discussions in the new year. They've managed to clear the way on social security, I think. So what are the sticking points now?
No, absolutely. The political situation remains problematic. You know, we have a fragmented parliament between the Conservative Senate and the left-leaning National Assembly, but also within the National Assembly. And on top of that, political parties are unwilling to compromise and are looking to bring home some major concessions, like a higher taxation on wealth for the Socialist Party, for example. But on the budget itself, we think that the compromise is within reach. Some 10 billion euros of tax hikes or expenditure cuts are only missing to reach the 5% deficit target in 2026, which I guess is doable in the first weeks of the next year. And as a matter of fact, as you said, the political risk premium in the market is fading, and the spread over Germany is now back to its August level, which is quite a good sign, I guess.
And Jean, your analysis suggests that France could actually save billions by borrowing short-term debt and changing their focus along the curve.
Well, absolutely. To take a step back, France needs to find more than 100 billion euros of savings over 4 years to reach its European commitment of bringing its deficit back to 3% of GDP in 2029. So to do that, spending cuts and notably a new pension reform and tax increases really remain crucial to keep the deficit under control. But in this context, we also looked at the impact of issuing shorter-term bonds to just reduce interest payments over time. And our analysis shows that it would help, especially if the ECB were to be more dovish, for example. But it would also come at a cost. And it would notably increase, obviously, the rollover risk, which means that this is ultimately a trade-off that the politics has to make between risk and savings, basically.
OK, Jean Dalbar, there, economist at Bloomberg Economics. Merry Christmas to you. Thank you so much for that analysis. Well, we can get more perspective on this time from the credit markets. ALEXANDRA Ivanova, INVESCO's fixed income fund manager, joins us around the desk. Good to see you, ALEXANDRA.
Morning.
So we had Jean there talking about this strategy of borrowing short-term debt, maybe an advantage for France. Doesn't that assume that the ECB keeps cutting at a time when we've got the likes of Isabel Schnabel talking about hikes?
Well, I mean, if we talk about the ECB, I do think that we are in a very good place at the moment. At least inflation seems to be under control. And my inclination is that to think that inflation is actually going to undershoot with the euro strength and some inflation, imported inflation from overseas. So I think it does help countries like France and Germany to fund themselves. Obviously, the fiscal stance in both countries or any other country to be around the world is also going to deteriorate in the next couple of years. And given the yield curves and the steepness in the yield curve, it makes sense for the issuing authorities to focus on the short end of the curve so that the cost of this funding is not necessarily that high. I would say that the reaction in the bond market tells you that, yes, we are kind of benign and okay, but we are not really rallying on the back of this because the premium that we need to get for this political uncertainty will continue.
Yeah, interesting, though, that you're kind of dovish on the ECB, despite that hawkish repricing we saw off Isabel Schnabel's original comments. So then, are OATs attractive? Is this a moment where you take the opportunity to buy them, or do you just kind of steer clear of them because of the political turmoil?
Well, for me, I haven't been buying OATs all year. A reason being is that it's much easier for me to have better conviction in credits. So within French credits, maybe banks, some of the lower-rated hybrids, and the bonds tend to react to this kind of news, and that gives an opportunity. But from the sovereign side, I would probably be neutral or just underweight.
So that's interesting. So sometimes when we get these wobbles around the macro and the European government bond market or the sovereign, it actually acts as a buying opportunity for French corporate credit, because some of these companies borrow at cheaper rates than the sovereign, don't they? And so where do you see those opportunities playing out next year?
So, yeah, that's true. And also, fundamental picture in corporates is much better. And I do think that, for example, the banks are very well capitalized, and some of the subordinated bank paper looks quite attractive, and especially given the fact that the yields and also coupons that are coming through in those bonds are still attractive. And if the market says that there's need to be an extra premium for that, that gives me an opportunity to step into that.
Yes. Alexandra, you say in your notes that in terms of asset allocation, uncertainty is lifting. And that sounds like a nice conversation to have on the 24th of December. So let's think about where you see uncertainty lifting. Is that because you don't see a repeat of the tariff drama and Liberation Day, so-called, in April of 2025? Does 2026 look smoother? How can we be sure?
Well, I always go back and say, if we were sitting here back in 2024 and thinking about what is going to happen in 25, even if we had a crystal ball and knew that the tariff war is coming and the AI trade will come in, I don't think that we would assume that the risk markets are going to be where they are today. So it's very difficult to say, yes, I do think that the path in 2027 looks quite resilient, but given how the market reacts to all these headlines is sometimes not necessarily logical. So it helps to be prepared for these kind of eventualities. But I do think that the peak of uncertainty and trade wars and April type of spikes are probably not going to repeat in 2026.
But in 2026, you could have different risks, right? What if you have the Supreme Court striking down the Trump tariffs? Would that give you concern for treasuries in the sense of how does the president fund his tax cuts?
That's absolutely right. In fact, I have been quite negative on treasuries, given the fact that they have outperformed this year. And being an active investor, we have been in and out of these markets. And in 2026, I do think that there is a scope for treasuries to slightly underperform and curves to steepen more than in other government bond markets. And you also saw that the Treasury is starting to issue more in the bills, and then the Fed is also looking and very attuned to liquidity pressures, and they have announced last meeting that they will be buying more of the T-bills. So you kind of can see that it's in the next year we could see some kind of flaring up of risk premium in terms of the Fed independence or inflation coming back. We were talking about inflation risks with the previous guest, that I do think that the heated economy and at the back end of 2026, we might see some inflation.
That could be a story. I wonder, from a macro perspective, Alexandra, how does the job story fit in with all of that? Because I was drawn to the conference board assessment of the jobs market yesterday, where they asked people, are jobs plentiful or difficult to find? And that assessment has been deteriorating, you know, quite rapidly, and stands in contrast to all the other signals out of the US economy, the strong GDP number, for example, and the strength of the corporate earnings story. I wonder if what happens if GDP runs hot but jobs run cold. How does that play out as a scenario next year?
So that's quite risky, I would say, because on one hand, the Fed will be on pause or continue to cut because the labor market is going to be weak, and the economy is growing very strongly, jobless growth. Probably it's coming through productivity. We still don't know yet because it's going to take a long time for us to realize the productivity from AI, for example. But that risks more inflationary environment in the back end of 2026 or 27.
And puts the dual mandate sort of in tension with itself, I suppose, at the Fed, which could be an interesting one to watch.
Alexandra, I've got to ask you about the UK, because I've been surprised, to be honest, that so many guests who've sat in your seat this year have not been as concerned about the backloading of fiscal tightening as you are. I think you are. What happens to gilts next year if we do see Starmer really weakened at those May elections that are coming up?
That is a major risk for gilts. So I think we have seen the relief rally after the budget. Well, and long-awaited budget, and uncertainty again is lifting from the corporate side, for example. But what I say from an investor perspective, it was a good opportunity for us to actually take some profits on our long gilts positions, because we do believe that the gilts might be volatile and will continue to be weaker, at least in the belly of the curve, how we call it, because that's where you can see more freely priced pricing. The long end, very, very long end, is going to be a bit supported by the fact that we will have much less issuance, I think. So I think it's a little bit barbell positioning for me.
OK. It's an issuance story for both the UK, France and the US.
Yeah, one to watch, certainly. Alexandra, thank you very much. Thanks for being with us. Alexandra Ivanova, Invesco's fixed income fund manager. Coming up on the programme, we will be hearing from Standard Chartered's top management, who spoke to me as part of Bloomberg's Chief Future Officer programme earlier this quarter about plans to deploy new technology, whether that's in the digital payments space or the AI space. Highlights from those conversations coming up next. This is Bloomberg. Welcome back to the opening trade, 7:45 here in London. Like many global banks, Standard Chartered is looking to improve its wealth management business as a key area of growth, and where that meets the digital offering is really interesting. I've been catching up with the lender's CFO and CEO as part of the Bloomberg Chief Future Officer programme. They discussed plans for developing, within wealth management, their digital offerings.
The game here is understanding. These digital assets have the ability to change the payment landscape of the world. And we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. So what we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
And the two leaders also spoke about the transformative impact of artificial intelligence on all levels of the business.
AI has the ability to fundamentally allow us to invest more in the areas that grow the fastest, while automating and changing the way that we do other things. It's a substitution effect. And it's not just a substitution effect in terms of people, because don't think of it that way. Think of it as an enhancer of productivity.
I think the set of tools around AI will be amongst the most powerful in my working life. I expect maybe the most. It's already changing the way that we monitor large volumes of transactions to help protect the bank. So fraud prevention and detection, transaction monitoring to be sure that we're in compliance with anti-money laundering and sanction compliance rules. But right now we've got, I think, best-in-class tools, and certainly in our markets, Asia, Middle East, and Africa, for delivering AI-based advice augmentation tools for our relationship managers and our wealth business.
In finance, as a CFO, you live with a lot of numbers and a lot of paper. You used to have to look at those numbers and that paper. Today, we almost talk to our numbers. We talk to our numbers, and our numbers talk back to us. That's one of the great powers of AI.
We talk to our numbers and our numbers talk to us. I thought that's one of the best lines on AI. Coming there from the CFO of Standard Chartered, Diego Di Giorgi, as well as the CEO, Bill Winters. They both spoke to me for an episode of Chief Future Officer that aired on November the 19th. The episode is still available to view, though, on Bloomberg.com. Lizzie.
Well, turning now to our MLive team, and Bloomberg's MLive's Adam Linton joins us round the desk for 3 minutes, or maybe more, Adam, this morning. It is Christmas Eve, why not? Look, I'm just flicking through the blog here, and Ven Ram says that the euro is going to be resilient in 2026. Our last guest, who was sat where you are, was telling us that the ECB is going to keep cutting in 2026. Do you think actually maybe the risk is the euro's more vulnerable? I'm setting you up to challenge Ven here.
Yeah, without getting into conflict with Ven on Christmas Eve, which is something I want to avoid. Yeah, I'm slightly more bearish probably than Ven is on the euro for reasons I kind of stated. You know, I mean, for example, I don't really buy into this ECB rate hike story. I just don't think, you know, we really need to start pricing that at the moment. We're at 2%. We're not at negative or 0% interest rates. And, you know, there's a lot of optimism priced into the European growth outlook next year. I mean, Germany's particular case in point. We saw that Bundesbank report last week, which was particularly bullish, but then some of the survey data from Bloomberg, that's been a little bit more pessimistic. And then also, you know, you've got places like France. Yes, they've kind of kicked the can into 2026. And I think there's a bit of market relief that the political situation is actually stable. Because what the market has been concerned about is the risk of snap legislative elections or presidential elections. So, yes, there's some, you know, reprieve on that front. But the actual fiscal situation in France is still, you know, particularly perilous because, you know, they're looking to cut their deficit to 4.7% of GDP. These latest measures may get it to 5.3 from 5.4. That's not really an improvement. And, you know, if the euro gets swept up in this, you know, global rate story with rates moving higher, if it does happen, that's not necessarily positive for the euro. I mean, those French funding pressures are going to be even more extreme. And there's been some good work by Bloomberg noting that with the France shortening their maturity profile, that leaves them more vulnerable if rates do go higher. So high rates may not even be a positive for the euro if they do come.
OK, yes, that's an important, that link between rates and the sovereign story. Let's pivot to the UK, shall we, Adam, because we've had a lot of conflicting conversations, actually, about gilts. So let's start with your Bank of England outlook. What are you expecting to see there? Because there's still pricing in of rate cuts, but not everyone's quite so convinced.
Yeah, when it comes to rate cuts, I'm more the singular than the plural. I think, you know, we got that rate cut last week, but it was very hawkish in nature. And I think what we saw in the minutes was very telling. So even though we saw that soft inflation data the day before, those contingent of hawks on the board just aren't willing to budge. They're still concerned about the strength of underlying inflation. They're even questioning whether policy is actually even that meaningfully restrictive. Then in the minutes, we also saw the Bank of England hint that the closer we get to neutral, which, OK, we don't necessarily know where that is, you know, Bloomberg thinks it could be around 3.5%, which would, you know, suggest 25 basis points left to get there. The Bank of England said those decisions are becoming more contentious, which is kind of a hint to say you can't really expect too much more from us at this juncture. And I think you'll see some of the cautious cutters like Bailey, Breeden, they'll move back into the unchanged camp in February.
And Adam, you can play the ref now, because we've had lots of different views on whether we should be nervous about that backloaded fiscal consolidation that was promised by the Chancellor in the budget. The last guest says, yes, you should be worried about it. Where do you land when it comes to gilts?
Well, I wrote a column a few weeks ago being relatively bearish on gilt, so I'm still very much in that camp. I think there's a few things that investors need to be concerned about. Like I just mentioned, they're not going to get support from the monetary policy channel. If global rates keep going higher, that's going to be a headwind for gilts. Then also political risk has not gone away. Yes, there's a bit of reprieve from the budget, but I think the May local elections could be pretty telling. Labour not polling well. I don't think it's unfair to say the market is not in love with Starmer and Reeves, but they're tolerating them. But I think there's a big fear of what could potentially come next if Starmer's premiership is to be challenged. And if you look at betting exchanges, the most likely year for Starmer to step down would be this year. And then, like you said, exactly, the back-ended nature of some of those fiscal measures, that's a real concern as well, because a lot of those are coming in 2029, which would be the run-up to the election. And history suggests that it's not a particularly good policy for a government to start jacking up taxes in the run-up to an election. And then also, some of the assumptions for the OBR, which are underpinning the fiscal headroom, they're particularly optimistic on consumption. And, the UK economy isn't exactly running hot at the moment. And I think there's a Bloomberg article a few weeks ago suggesting that if, the UK economy does falter, these consumption forecasts are not met, that could blow a £40 billion hole in the public finances. And the market just isn't pricing that.
OK, Adam, thank you very much. Adam Linton from the Markets Live blog. You can get more on the terminal. MLIVGO is the function to use to find that blog. Lizzie, we thought we would have no stocks to talk about today.
But we do.
But we do. We have BP and we have Sanofi. I'll start with BP agreeing to sell a majority stake in its Castrol Lubricants division to Stone Peak Partners to raise about $6 billion. Of course, trying to reduce their debt is the focus there.
Yeah, we also have Sanofi agreeing to buy Dynavax Technologies for about $2.2 billion. They're trying to expand their vaccines business, which is currently anchored by a flu shot franchise. That's hard to say. We'll bring you the open next. Futures pointing south. This is Bloomberg.
Welcome back, everybody. It is the 24th of December, a few minutes to go until the start of equity trading for what will be a shorter than usual trading session. And we are without a number of geographies. But let's focus on yesterday's session in the US, which got a really decent boost from some of the data, in particular the GDP data, despite the consumer confidence data. But GDP data helped to secure some decent gains for US stocks yesterday. Europe closed out about here, so you could see an argument for going higher. But maybe this is much more of a stateside story. Futures certainly not suggesting that we're expecting to price in a lot more positivity this morning. So we've got here FTSE futures, CAC futures, Amsterdam futures, because not all of the markets here in Europe are trading today. We have a number, certainly to the east of Europe. Many of those markets are already closed for the Christmas holidays, and others have a shortened trading day. So here in London, for example, and over in France, probably, we'll have a shortened trading day for those markets that are open. Lizzie, what are we watching in terms of individual stocks? We've got some asset buying and selling to pick up on.
Yeah, despite everyone slacking off, we have actually got some M&A for you. So we look at Sanofi. They're buying Dynavax for $15.50 a share in cash, so watch those. Then we also have BP set to sell a majority stake in the Castrol Lubricants unit, so divesting a 65% stake in that, netting proceeds of about $6 billion. Mind that. And then finally, the miners, because of course we've got the metals up, gold, silver and platinum hitting records. So Anna, we keep an eye on Fresnillo in honour of our own Guy Johnson.
Yeah, absolutely. So some of those mining names could certainly be in focus. Yeah, new records on gold, new records on silver, all of those mining stocks then very much in focus. Is the metals gain crypto's loss? That's something they were talking about on the Markets Live blog. But we will focus in on equities right now, because European equity markets are opening up for the not the last trading day of the year by any stretch, but certainly the last one before Christmas. And we have the FTSE 100 just opening up pretty flat, actually, this morning. I'm sure, like many people, feeling pretty sluggish on the 24th of December. So the FTSE 100 illustrating that very nicely for us. The Stock 600 is flat to the upside. We are expecting an opening on the CAC. We're expecting the AEX and the IBEX. In fact, we're expecting an opening on all of those markets. But be aware that the German market is closed, the Swiss market is closed, many of the Eastern European, Scandinavian European markets are closed, so we'll certainly keep that in mind as we watch these modest moves at the start of the trading day. Actually, the IBEX down 0.2%, but overall then, Lizzie, a flat start to the Christmas Eve trading day.
Yeah, and bearing in mind that these are thin volumes because of the holiday season, if we break it down by sector across the stocks 600, we have about 3/4 in the green this morning. Energy leading the gains up 0.25%. Food, beverages and tobacco, how seasonal, isn't that? Up 0.2%. But bottom of the basket is tech, down 0.1%. Banks, retail, utilities and media, all in the red. Now, I flagged a couple of stocks to watch this morning. If we go to those, Sanofi is pretty flat, actually. To the upside, though, after the announcement that they're going to buy Dynavax for $15.50 per share in cash. We've also got the BP M&A news. They're going to sell a majority stake in Castrol. Those shares up 1.1%. So that was a sale process that started under Murray Auchincloss as CEO, and now that will give an inheritance to Meg O'Neill. And then Fresnillo, Guy's favourite, up 0.4% on these metals moves. So just one of the miners benefiting from those records.
Interesting that it is that M&A story, or at least the asset disposal story around BP, that is lifting the energy sector. A number of stocks still not open yet this morning. It's certainly giving us a sense of where people's heads are at this morning, and it's perhaps not here on these markets. But energy stocks are making the best of it this morning, up by 0.5%, and BP is the best performing stock within that basket, and so we will watch the energy names closely this morning. Let's get some perspective on the year ahead. ALTAF KASSAM joins us, Europe Head of Investment Strategy and Research at State Street Investment Management. ALTAF, very nice to have you with us.
Good morning.
Thank you so much for being with us. We have lots to talk about, of course, the central banking backdrop, AI, such a big theme this year going into next year. But just because we've had this news flow around BP and Sanofi, and we seem to have had a lot of false starts on the whole M&A, is it back conversation, but it does seem as if it is back. Is that going to be something of a theme that we lean into in 2026, do you think?
Yeah, I do think M&A is back. We've had corporates sitting on huge amounts of cash on their balance sheet, waiting for the right time to put it to work, and it feels like now they're deciding to pull the trigger. So I do think that will be a theme for next year. Consolidation, the rewiring of the global trade order, I think that all comes together into spurring M&A to improve efficiency and kind of make sense of how the world is set up, you know, given all the policy moves we've seen over the last year.
Yeah, I mean, that's interesting, isn't it? Because private equity, for a long time, we were thinking about how they weren't able to exit, and this was a bit of an issue for some of these private equity businesses, but they seem to have been doing just fine. Private equity, private credit, real boom times in those sectors, despite the fact that they couldn't exit. So now what happens with private markets, thinking sort of widely about the investable universe in 2026?
Yeah, I think it just grows broader, because what we've seen is that, you know, long bonds don't do the job they used to in terms of diversifying equity risk. And so people are having to look much more broadly at different sorts of diversifiers, and private credit has certainly been one of them. And what we're seeing is there's a lot more interest now in secondaries. So it's not just about getting involved in the primary market, but looking at secondaries as well. And for secondaries, the great thing is that there's a lot more access, a lot more types of investors can get into them. You don't have to be a huge, you know, pension fund, which you do more with the primary side. So we think that there's still a lot more room, a lot more breadth in private markets, and we think that that flow will continue.
ALTAF, Anna mentions you're a bit concerned about the AI names and maybe a slowdown in some of the hyperscalers. I just want to put it to you, you know, not all of the Mag 7 names have done that well. Some of them have underperformed the S&P so far this year. Doesn't that show actually that there's room to run, that not all of them are, you know, at runaway valuations?
I mean, I do think most of them are at pretty steepling valuations, whether compared to their history or compared to their peers outside of that small universe. But at the same time, we do agree that there is more room to run. We do believe in the AI story fundamentally as a productivity enhancer. We see the adoption increasing, not just in tech, but throughout industries outside of tech. And we particularly pinpoint like healthcare and industrials as two sectors which should benefit from the kind of the trickle down of AI. So we think there's room to run. We just don't think it will be so concentrated in those large cap US tech names.
Okay, really interesting. And you're pretty dovish when it comes to the Fed next year. I think you're expecting up to 3 cuts.
Yeah.
How much is that important for sustaining the rally when it comes to stocks?
I think those 3 cuts are important for this idea of more breadth in the market. So if we do get 3 cuts next year, then it should benefit more the smaller names, the ones who rely on more short-term financing, who have higher financing rates at the moment, and less those big names that we just talked about. So for our thesis of a more broadening of the rally to happen, and for other markets like emerging markets to continue to rally, we do need that more accommodative Fed. And yeah, we are kind of at the end of the spectrum in terms of dovish views on the Fed, definitely.
And we're going to be having another conversation about fixed income markets later on this hour, ALTAF, but just to get your perspective a little more on this. I mean, does that mean that then if we got 3 cuts from the Fed, I assume that would really anchor the short end?
Yes.
But what happens to the long end and how that fits with the objectives that we think the Fed has, the government has, because the government's been quite outspoken on what it wants to see from the Fed?
Yes, I think we can be more confident on the short end. At the long end, like I say, what we have seen is that fiscal issues, which have always been there, have really come to the fore, and the market has really started to worry about them, whereas maybe a few years ago it was a tomorrow problem. Now it feels like it's become a much more current and pressing issue. So I think we will continue to see a bit more bear steepening in the yield curve. And again, that means that long duration bonds won't quite be the hedge that they have been in the past for equity risk. And, you know, we'll see more investors looking at different ways of hedging their portfolios.
And thinking about AI, you were just discussing this with Lizzie, the concerns around AI. What do you watch then to see when we run into trouble there? You offer a number of suggestions around free cash flow, profit growth, the cash being thrown off relative to market cap. I mean, what's the sort of secret sauce for spotting when this turns sour?
Yeah, I think, I mean, we and other portions of the market have become a bit more worried at the debt financing that's starting to occur, and reports that this might be moving off balance sheet, so it becomes harder to spot. So that's something that we're keeping a very close eye on. Is this self-financing, or are companies having to lever up? And then looking at the adoption, you know, basically this has been an earnings story. If you look at what's driven the US equity market this year so far, it has been an increase in earnings, not an increase in valuations. But if that starts to turn and we see PE multiples start to go up but earnings not keeping pace, then we will start to get more worried as well. So it's about really trying to stay with quality names and not just buy anything.
Yeah, I mean, I thought that was one of the ways that this differed from the late 90s, was that actually this wasn't a worry about debt. But you're saying it could turn into one.
Yes, so that's exactly what we're keeping an eye on. Those of us old enough to remember the late 90s, remember that at the end there was a lot of levering up, a lot of buying of infrastructure that didn't get used then for decades afterwards. We're trying to make sure that this doesn't happen again.
ALTAF, we started the show with the President's musings on the relationship between economics and markets and whether good news is good news. I wonder how you reflect on the GDP numbers yesterday. Is it kind of a vindication of the stock rebound that we've seen since April in the US?
Yeah, it feels like a good news is good news story this time. And it was surprising and definitely outside of consensus in terms of the strength of that GDP number. For us, yes, it's a vindication. We'll kind of remember that the Fed's mandate is not about GDP growth, it's about inflation and it's about employment. So those are the two indicators we'll be looking most closely at to try and understand if our Fed view is on the right path. But certainly the fact that the US economy seems to be powering ahead is unequivocally positive for us.
And what if their intention, ALTAF, this is something that fascinates me, you know, what if they have to focus on inflation and they have to focus on jobs? What if the jobs story, what if inflation gets a boost because the GDP growth story is strong, the earnings story from corporates is strong, stock markets are doing fine, but on the other hand, the labour market is weak? What if some parts of the US economy run hot, but jobs are weak, and this could be structural because of AI? Is that something we need to be increasingly aware of? One of the ways that we watch the K-shaped dynamic play out, not the usual one, not about two parts of the consumer basket, but another K-shape, I suppose, to focus in on for 2026.
Yeah, you took the words out of my mouth. That is very kind of a good interpretation of how this could pan out. And if we see a weak labour market but strong inflation, then it does put the Fed in a much more difficult position. And then, frankly, we do have to think about the composition of the Fed board and how that moves forward and who the new chair might be to get an understanding of how things might move in that direction. But it becomes a lot more of a difficult decision if we do see a divergence between unemployment and inflation.
So not just a K-shaped economy, maybe an economy doing the splits in 2026. ALTAF, good to see you. Thank you for coming in.
Thank you very much.
ALTAF KASSAM, Europe Head of Investment Strategy and Research over at State Street Investment Management. Well, Well, coming up on the programme, we're going to hear from NOVO Nordisk's CEO, Mike DOUSTDAR, on the pharma giant's Wegovy pill approval. That conversation next. This is Bloomberg. .13 a.m. in London, and we're reflecting on the massive moves we saw for Novo Nordisk yesterday, up on both sides of the Atlantic, after the Danish drug maker won approval to sell a pill version of its blockbuster obesity jab Wegovy in the States. The CEO, Mike DOUSTDAR, spoke to Bloomberg about how the development could shake up the competitive weight loss environment.
This is really going to be super exciting for the millions of patients that have been waiting to get their hands on a GLP-1 pill. And for the first time, we are having a pill that has an efficacy of some 17% if you take the pill regularly, and 1 in 3 people are going to actually reduce up to 20% weight loss. I think that data speaks for itself, and we are super excited, of course, to be the first to the market, and we're going to go all in trying to make this a huge success.
Well, moving forward, I mean, beyond just these first few months, after Eli Lilly does have their pill on the market, how do you plan to compete? What is your strategy there, given my understanding is that there's likely going to be no restrictions when it comes to food, when it comes to drinks, around Lilly's version?
Yeah, so as I mentioned, there are no other phase 3 trials of oral GLP-1 that has shown this level of efficacy. This means that for the first time ever, people do not have compromise between either taking an efficacious injection or a convenient pill. For the first time ever, you have the same efficacy of 17% in injection or a pill. You can take it on a daily basis as a pill or a weekly injection. And that, I think, is the key selling points with Wegovy pill. We also have more than 10 years of course, experience with regards to safety data and what have you. That's why it's called the Wegovy pill, which means that this pill is not only going to reduce your weight, it also has protection for your cardiovascular systems. So this is a phenomenal pill, second to none, I would say, and we are very ready to compete with it.
Let's talk about how you're going to sell it. Through what channels will you sell this Wegovy pill, and will all of those channels be available at launch?
The quick answer is yes. We're going all in. We're, of course, going to sell this through our own websites, NovoCare Pharmacy, as well as all of our partners, be it Ro, LifeMD, Costco, Weight Watchers. Everyone that you can imagine is going to start launching this at the same time on the day of the launch. Trump RX, of course, will be coming up soon as well as, of course, the traditional channels that usually medicine is procured in U.S.
Well, to that point that, you know, it's going to be widely available, let's talk about supply. I know that you've already started production. How confident are you that you're going to be able to, you know, meet all of that demand at launch, given, of course, the supply challenges that you've been through in the past?
Let me take you back, 10 years ago, when we started the journey of putting a peptide into a pill, no one thought scientifically that is possible. You have to remind your audience that pills are usually chemical entities, small molecules, and not proteins and peptides. And often they have lower efficacy because of that. When we decided to actually go this route, everyone thought scientifically this is impossible. Then after that, when we proved them wrong, people thought that we cannot scale that because this is quite difficult to do, again, because it's large molecule inside a pill. Again, we have shown confidence that we are able to scale this more than enough for every single person who would want to take the pill, and we're ready for that. And then, of course, lastly, people are writing us off that, this would not be possible at an affordable price. And I'm also very happy to say, once again, we are proving all of these skeptics wrong. So I'm super excited that we have something that is borderline miracle, in my own humble opinion, a peptide in a pill with a high efficacy, produced at scale, and we're going to actually sell it through all channels at relatively affordable price.
I'm curious how you see this market evolving, whether you think that, having this pill version available will expand the total addressable market, the total number of patients that you can reach, or whether or not it might cannibalize the injectables that you're already serving.
In my own family and circle of friends, there are a number of people that have been very attracted in taking a GLP-1 product and reducing weight. Unfortunately, they have not, taken that journey because they've been either afraid of injections or there's the taboo of injection. I think a lot of these people today will be able to find Wegovy pill incredibly interesting as a way, again, to come in, get the same efficacy as your injection, but in a form factor of a pill. So in short, I think the market will expand quite a bit, actually, for many of these people that have just been waiting and seeing the injectable versions of these GLP-1 products taking the world by storm.
Novo Nordisk CEO Mike DOUSTDAR there speaking to Bloomberg's Katie Greifeld. And that's not the only pharma news we've got this week. It's actually turning out to be quite a busy week for pharma news. We've got Sanofi shares down 0.6%, and this is after the firm agreed to buy Dynavax Technologies for about $2.2 billion in a bid to expand its vaccine portfolio. We can get more on that story now with Bloomberg's health reporter Ashley Furlong. She joins us now. Morning, Ashley. Is this deal a surprise for Sanofi?
Very much so, because we're seeing this situation, obviously, where vaccines globally, we're seeing sort of a hit to vaccine sales. Sanofi itself has said at the last quarter that its vaccine sales were down. In the US, we have a health secretary, Robert F. Kennedy, who is almost systematically undermining some of the tenets of vaccines, really. But what we have seen is that's mainly targeting childhood vaccinations, and this deal is mainly focused on adult immunizations. So I'm assuming that Sanofi is hoping that adult immunizations are protected from those changes that we're seeing in the US. And obviously, this deal might take sort of several years to sort of show true value for the company. So we might see changes in the rules around vaccines in the coming years in the US.
Okay. So actually, that's the vaccine story around Sanofi. Today, Sanofi has also said that the US FDA rejected its drug for multiple sclerosis. What does that setback mean for the French drug maker?
So this is a significant blow. We'd already, in a way, expected, difficulties with the submission. The FDA had already delayed the decision date, and we were expecting this to potentially come next year. It's a surprise that this has come so quickly, and it's also a significant blow potentially to patients who, with this specific type of MS, which have few options. But for Sanofi, which is really trying to replace its leading drug, Dupixent, and that's coming. Generics are coming in the next couple of years for that drug, and this MS drug was supposed to sort of help it on its way to sort of replace those revenues. So this rejection in the US is going to be significant for it. Sanofi seems to hope that there's still a way forward, and it's still discussing with the FDA. But obviously, it is a significant blow. This was the potential for $1.7 billion US dollars in peak annual revenue, which would, those sales will only potentially come from the rest of the world now.
Ashley, thank you very much. Bloomberg's health reporter Ashley Furlong with the latest on Sanofi. Let's go to the BP story. The BP shares on the move. We talked about them being the best performer in the energy sector at the start of trade this morning after BP agreed to sell a majority stake in its Castrol lubricants division to US investment firm Stonepeak Partners to raise about $6 billion. All of this M&A keeping our reporters busy on Christmas Eve. Joining us for more, our Bloomberg big oil reporter, Mitchell Furman. Mitchell, thanks for joining us. How big a deal is this then for BP and for Stonepeak?
Good morning. Yeah, BP reset its strategic direction earlier this year, and a part of that reset was announcing a $20 billion divestment program. Castrol, its lubricants business, was the central divestment target for that program, and the expectations were that this asset could bring BP as much as $10 billion. And so as we see today, they sold a majority stake in it for about $6 billion.
And obviously, Mitchell, good morning. We know that BP is undergoing this transition period. It's getting a new CEO in Meg O'Neill. Does this sale mean that BP can streamline its portfolio as much, perhaps, as Elliott wants it to do?
Yeah, good morning. It's, it definitely achieves a target that BP set out earlier this year. However, a lot has changed since BP set out that target, right? There's a new chairman. You were talking about NOVO NORDISK. There's a bit of a through line with BP. The chairman that departed both BP and NOVO this year was Helge Lund. And his replacement at BP is Albert Manifold, who just started in October, and he is, as you say, he has made quick work with the CEO, changing out Murray Auchincloss for Meg O'Neill, and so there's still a lot of questions now about the direction of BP.
Yes, and let's think about those into 2026 then, Mitchell. I mean, this is a business that had, mishandled? Is that the way we describe it? A pivot towards renewables. Now it's going to be under a new management team. I mean, is this a sort of back to basics oil business? Is that where we're going?
That's what it appears, right? The new chairman said that he wants a simpler, leaner BP, and clearly CEO Murray Auchincloss was not the man to carry that out. And so Meg O'Neill, who starts in April, will have to lay out a vision that, could go a number of directions. But the thing that is clear is that it will be an oil and gas vision.
And do you think there'll be more HR personnel changes under Meg O'Neill's leadership then, if it's going to be a serious pivot, a hopefully successful pivot for them this time under her leadership?
Yeah, I mean, there are a lot of unanswered questions. Staff internally, as we reported on Bloomberg late last week, staff is uncertain about what's happening right now, what's going to happen. They have gone through years of transformations, of strategic pivots, and now they have another pivot. Murray didn't even have a year to kind of carry out his plan, and now they're going to have a new CEO come in. Most people internally at BP were shocked by this kind of sudden announcement. That shock is probably what investors were looking for to some degree. But as a result, there are a lot of questions about what's next, and Meg will have to answer those in due time.
OK, Mitchell, thank you very much. Thanks for joining us. Bloomberg's Mitchell Furman with the latest on BP. I mentioned that it was the best performer in the energy basket this morning. It's not quite now, and it's only up by 0.4%. But that asset sale, long awaited, it seems, by investors, and certainly something to focus on this morning. And in terms of markets then, Lizzie, a kind of quiet morning. We have a lot of markets already closed.
Yeah, we do. Germany, notably, the DAX not trading at the moment, but the FTSE 100 is the underperformer. The CAC 40's up 0.2%. Sectorally, it is still energy leading the gains, even if the BP gains aren't as pronounced as at the start of the session. Tech's at the bottom of the basket, about 3/4 in positive territory.
Yeah, and so for those markets that are open, we're expecting an early close for many of them here in Europe, and then into the States, also early closes there. But yes, we don't have a lot of participation in European equity markets today. Many of the Eastern European markets, Germany, Switzerland, all closed for the day. 8:26 here in London. We will get more on the market. Stephen Major joins us to talk bonds. This is Bloomberg. Welcome back, everybody. This is the opening trade. We are 30 minutes into your session this Christmas Eve, this Wednesday. I think it's Wednesday. Feels weirdly like a Friday, doesn't it? FTSE 100 is pretty flat right now. The CAC 40 is up by 0.2%. The Amsterdam market pretty flat as well. Broadly speaking, we are pretty flat around these European equity markets, such as they are, because a number of the markets are closed. We have no DAX, we have no Swiss market, we have nothing in Eastern Europe, a lot of Northern Europe also out. And those markets that are open, they will be closing early and probably have quite low volumes attached to them. Let's get an update on that side of things from Lizzie.
Well, yeah, not a lot of volume to be spoken of at all this Christmas Eve, Anna. We are down nearly 100% against the 20-day average. But if we look across the stock 600, pretty even split between the members higher and lower this morning. If we dive into who some of those leaders are, it comes from the energy space. Of course, we've got the M&A news from BP selling its majority stake in the Castrol unit, and BP shares up 0.4% this morning. Gains also for the likes of Shell and Total. But if we flip over to the laggards, it's a healthcare pharma theme this morning. We also had the M&A news for Sanofi buying Dynavax. Actually now, shouldn't be on this board, should it? It's in the green. It just has flipped into positive territory as we've been speaking, Anna.
OK, so a bit more of a mixed picture then coming through from those pharma names. Let's talk about some of the other stories we need to keep across this morning. Gold hit yet another all-time high on escalating tensions in Venezuela and expectations for more US rate cuts. Gold has gained more than 70% this year and is on track for its best annual performance since 1979. The US has accused China of engaging in unfair trade practices in the semiconductor sector, but the administration has decided not to impose additional tariffs on chip imports until at least the middle of 2027. China responded to the US notice by saying the country remained opposed to the, quote, abuse of tariffs, and asserted that global chip supply chains are shaped by market dynamics and business choice. Treasury Secretary Scott Bessent is calling into question the Fed's 2% inflation target, saying the complexity of the economy warrants a broader range for inflation targeting rather than an exact decimal point. Fed policymakers adopted the current 2% target back in 2012, and it's shared by many central banks around the world. Food for our next conversation, perhaps, Lizzie.
Indeed. Well, let's speak now to Stephen Major, Global Macro Advisor at Tradition Dubai. Good to see you, Stephen.
Thanks, Lizzie.
It's Christmas Eve.
Nice to see you.
I wonder what you make of that suggestion by Scott Bessent. He's not saying do it now. He's saying when we get to 2%. But isn't that going to lose credibility anyway if you move the goalposts?
So don't forget, during COVID, so 2020, the Fed changed to flexible average inflation targeting, and then they quietly sort of walked away from it because they hit the inflation numbers very quickly. So in fact, the moving average went quickly above the inflation target. And then in 2025, this year, there was another review. I sense that there is a form of average inflation targeting anyway, and the UK has it, Australia has it, and so I think he's actually just saying what is reality, because it could be more harmful to target something so precise. Because what happened with the 2.0 target is that for a decade they undershot it by an average of 30 basis points over a 10-year period every year. So the objective was quite a noble one, to try and get some of that back, because it's bad for the economy in the longer run to have that disinflationary edge. And so I think that he's just speaking the truth. I mean, it's realistic, and no one's throwing the target away. They're just saying, give us a bit of wiggle room, right? And so to hit a 2% average over the longer run, you're going to have some 3s and some 1s. That's just how it's going to work, right?
OK, so maybe it's just the realistic thing to do to acknowledge that that's already what's happening.
Yeah, I think he's just speaking the truth about what has already happened, and so other countries are doing it, and he's quite right, it's complicated. So how do we measure the disinflationary impulse that might come from AI and the productivity against the GDP boost it might give, right? So in fact, inside the nominal GDP number, it may end up flat, but there could be a downward pressure on inflation because of jobs and that kind of thing, and an upward pressure on the real GDP, but the nominal number ends up flat. I mean, I don't know. I'm just saying, for example. Right?
Yes, yes, this could get complex, couldn't it? I mean,
there it is.
Does it mean that? Does it mean though that it allows the central bank, because it's got a dual mandate, the Fed, which is a bit different to a lot of central banks, or at least some of the majors. Does it mean then that it gives more space to put the emphasis on jobs? Does it suggest more of a primacy of that goal?
Well, it's designed for that.
Yeah.
And let's not forget, Anna, that the ECB has modified slowly from that rigorous 2.0. It's bringing in other angles. And I think through time, everyone is going to have a more flexible mandate.
Well, you wonder whether the Bank of England should follow suit and actually have a dual mandate of its own, given, you know, you had that inflation reading and the vote split not really reflecting it. Should they be honest about what they're doing?
Well, again, if we look at the historical patterns, the UK has had quite a volatile movement of inflation around the target. So that's just, it's kind of a historical fact. So any change in the mandate, for what it's worth, is only going to fit with what we're seeing. Right? The UK is a small, open economy. Therefore, it gets buffeted by what's happening elsewhere. And you can see how sterling can have a big impact on the UK numbers in a way that maybe the dollar doesn't in the US, because it's a large, closed economy.
Yeah. Back in the US, and thinking about the job story that we were just talking about there, or whether this a range around inflation gives more room to focus on jobs, perhaps. I mean, what happens if the jobs market deteriorates, Stephen, but the other indicators of the US economy look quite good, and therefore the dual mandate is in tension? We were talking about this earlier with another guest. Maybe you have a different view on inflation, but is that a possibility?
Okay, so the literal interpretation from the Fed Act, I can't even remember which clause it is, but I did look at this before, is it will depend about how far they are away from the number.
Right. Yes, he's talked about that recently.
Yeah, so that would tip the balance. So if for sake of argument, there was an objective of unemployment, what is it, 4.5 or something, and they were 1% away from that, is that of big enough magnitude compared to the overshoot on inflation, for example? So if you had 3 on inflation with a 2% target, I don't know.
Yeah, I guess I'm thinking about AI and what that might do to labour markets.
But I'm glad we're having such an adult conversation about this, because there is a cynic's view that they're going to cut anyway.
Right,
because they're going to put a personality in the US.
Is that a cynic's view or a realist's view? I don't know. Maybe it's both.
Well, we've got to talk about it, have we not?
It's. You can look at the betting markets, and it's telling you all you need to know. You know who the 4 candidates are, and you know that 2 of them have got a first name of Kevin. So what more do you need? It strikes me that even if this new Fed chair that doesn't take the seat until the second half of next year, doesn't really matter, because if we know in January who it is, the forwards will price the right amount of easing for what that person's likely to lead.
But would you expect Kevin Warsh to be much more hawkish than Kevin HASSIUM? Yeah,
it sounds like it, doesn't it? Just based on all of the information we've got. But I think that whoever the Fed chair is, the probability of us going to something with a 2 handle is much higher than with the current Fed chair. Yeah, and the question is, how fast do they get there? This year we had to wait a long time, and then we got a hat trick of rate cuts in the last couple of months, right? So next year it might be that it's all crammed into the second half of the year, but it doesn't really matter. The forwards will price with a 2 handle rather than a 3 handle, and that's it. And that will just drag the whole curve lower. And
what happens? So it drives the whole curve lower. That's interesting, because what we've seen so far with the US is lots of cutting that has sort of weighed on the front end, as you might expect, but hasn't necessarily played out in the long end as other cycles have suggested it should do.
That's right.
Do we break that at all, Stephen, or are we stuck in that range, stuck in that sort of regime rather?
Just one caveat, by the way, it is contingent on the data. I'm making it sound like it doesn't matter at all, but you said a blowout GDP number.
Yes.
Unless there's something fishy with it, which I haven't discovered. But so let's not forget that. There has to be a get out, right? It has to be. It depends on the data, kind of thing.
To use Anne-Marie Modern's very good word, you could see them cherry picking out of the data.
Yeah. And actually, what data are we talking about even? And has some of this data been managed a little bit? Because, dare I say, there's been a few questions about some of the releases and the imputing of
and
numbers.
it's sort of full of holes, certainly the CPI. But do you think, do we see a continuation of that pattern where the front end it responds to the Fed, but the long end just doesn't?
And I think this is critical, because how many people at the start of the year would have called a steepener and got it right for the wrong reason? Actually, in investing in markets, just take every win you can get. You just got to be humble. But the steepener was a consensus view, and it still is for 2026. But I look back at it and I think, well, actually, the long end didn't do much. The yields might have leaked a bit higher in the very long end. The 10s did nothing, but the front end rallied. So when you look back at it, was the steepener the right trade, or wouldn't it have been better just to be outright long? Because that's what it comes down to. Just receiving or buying would have been the right thing to do. And I look back at it, the impetus for the steepening, was it really US? What about Germany? What happened in Germany? Who predicted what was going to happen in Germany just after the tariff or around the same time of the tariff announcements, if I recall, the German defense spending? What about Japan? So it strikes me that Germany and Japan may have contributed quite a bit to the G3 move.
Okay, so the international dynamics.
And we all point the finger at the US fiscal policy. Actually, the US fiscal policy isn't as loose as people thought it would be at the start of the year. Actually, the deficits come in less than some people expected. So you know, I think there's a narrative that wants to point the finger at fiscal in the US and UK towards a steeper curve. But right for the wrong reasons, just take whatever win you can get.
Okay. Yeah, absolutely. Wise words, I'm sure. 24th of December, take the win. Stephen, thank you very much. Stephen Major, Global Macro Advisor at Tradition Dubai. Very nice to see you back in the studio here in London. Now, staying on the macro theme, central banks around the world this year have had to keep economies stable amid President Trump's trade tariffs. So what does next year shape up to look like? Let's get another perspective on this from our Markets Live blog. Currency and rate strategist Ven Ram is with us. So, Ven, set the scene for us. What is the mood music like then heading into 2026? The central banks are they going to be a huge mix of dovish, neutral and hawkish this coming year?
Absolutely. I think we are going to see the entire spectrum of it, Anna, because, you know, if you look at all the way in the East, what we've heard from Australia and New Zealand in the past couple of weeks alone is that they are moving away from a very dovish pivot to a hawkish one, because the labor, guess what, the labor market is tight. Consumers are spending a lot more than they expected them to. Core inflation in Australia and New Zealand is ticking higher. And the central banks are worried that, you know, the rates may not be as restrictive as they were thinking earlier. So we had some very hawkish remarks from RBA Governor Michelle Bullock, and I think that, you know, we know the case with Bank of Japan. They need to raise rates. They're behind the curve. So all that is permeating through to across the Atlantic, as Steve Major was saying. You know, a lot of it is showing up on rates in the UK and in the US as well. So, you know, definitely the mood is that, you know, it is a hawkish pivot as we enter 2026.
So, Ven, we know no central banker likes to admit a policy error or have to reverse course once they've started in a direction. Which central bank is most at risk of having to do that in 2026?
I think that the Bank of Japan has got quite a lot of work to do in terms of raising rates and tightening policy, because, you know, we've got a fiscally expansionary prime minister now, and she's unveiled fiscal expansion. And, you know, even independent of that, inflation is running at around 3%. The Bank of Japan expects it to come down to 1.8% next fiscal year. I don't know how credible that is, because inflation there again is sticky. And the Bank of Japan, for good measure, also expects trend growth to be above trend next year. All those point to a neutral rate of 1.5%. I'm not saying that. That's the Taylor rule saying that. So, you know, the Bank of Japan's benchmark rate is at 75 basis points. So that means that at least 3 more rate hikes are needed just to get even to the neutral rate, let alone a restrictive rate. So, you know, the Bank of Japan has got its work cut out.
OK, so that's the BOJ and the challenges that they face. They're moving in a different, in that hawkish direction then. What about the outlook for the Fed? So complicated by the usual factors, but with a sprinkling of politics.
Absolutely. I mean, politics, and the president may want interest rates at 1%, but I don't know if the new Fed chair is going to be able to find consensus. Why do I say that? The Fed itself thinks that core PCE is going to be 2.5% next year, and growth is going to be 2.3% if you believe the Fed. And we saw, of course, blowout numbers yesterday. And, you know, even if you take the latest numbers with a pinch of salt, you know, 2.3% is, you know, the US, the White House would take that, and the Fed would take that any day. So that's about trend growth. And you juxtapose that with core PCE that is still sticky, that points to a neutral rate of 350 to 375, which is exactly where the Fed is. So I don't know where the rate cut argument is coming from. Certainly, some members of the Fed don't see it, which is why they've penciled in just one rate cut for next year. So I think even that is being contingent upon inflation softening from here. So let's see how it goes. We've got the politics, we've got the inflation dynamics on the other side. Let's see how this is going to play out.
OK, Bloomberg's Ben Ram, thank you so much for that look ahead to the central bank story in 2026. Well, coming up, a few people are going to be doing their last-minute shopping today, including me, maybe at Nike. Up next, Bloomberg's Romain Bostic. It gives us a deeper look at the company's turnaround efforts. This is Bloomberg.
Welcome back to a festive opening trade. Nike products likely sit under many Christmas trees today, and it has been just over a year since the CEO, Elliott Hill, took the helm. Bloomberg's Romain Bostic visited the company's headquarters.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
Hundreds of motion picture cameras surrounding an indoor soccer pitch. Speed sensors encircling an Olympic racetrack, electronic pressure plates embedded in a basketball court, biometric hookups to assess a runner's gait and posture, a hermetically sealed room that mimics the brutal heat and humidity of a Tokyo summer. All told, more than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab. An evolution from the company's experimental kitchen counter roots and a nod to its future of putting the athlete first.
This is our Nike Sports Research Lab in our Innovation Center, and this is the home to dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete, right? Phil's point, we're in this amazing building where we have dreamers building the future and work with not only elite athletes, but the everyday athlete to take those insights and understanding and build not only for the elite, what you've seen being here today, but then are able to translate those innovations through every price point.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new Chief Innovation Design and Product Officer, overseeing ideas across the company's 3 units, Nike, Jordan, and Converse. They are 2 of the key players in CEO Elliott Hill's full-court press to reinvigorate growth following former CEO John Donahoe's reign. Under Donahoe, it was a tenure that saw annual sales begin to drop in 2024, as demand waned for the brand's lifestyle sneakers like the Nike Dunks, and as relationships with retail partners soured. Elliott Hill is now trying to plug the hole with a refocus on athletic performance.
We're going to obsess sports. I think that's been, since Elliott returned, that's been a key part of our charge as a leadership team, and we're already starting to see the fruits. You know, we spend a huge amount of time bringing athletes here. We text with Faith Kipyegon, Eliud Kipchoge, LeBron James. We bring them to our home and then we go to their homes. So the origination for ideas is always the athlete. That's at the core of everything we do. And then we start to think about how do we apply those insights broadly to the 8 billion people who we're trying to invite into sport every single day.
So when it does actually go to market, are you going to target it towards the athlete, or are you going to try to maybe just target it towards the casual wearer?
Everything that we do and the focus on performance is listening to the elite athlete and capturing that data and information to help lead this amazing innovation. So we will for sure be connecting this story exactly to our athletes, which or who helped give us those insights, who we tested with, and that will be how we determine how we tell that story going forward. So it's very much about the insights from the athletes, the data we captured, the innovation we're delivering, and helping communicate that to consumers all over the world.
The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. I even got a glimpse into the retailer's future with Project Amplify, a footwear system with lightweight motors and rechargeable cuff batteries that aims to help you move faster with less effort. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. You know, there's plenty of opportunities where technology, we have to sort of burn the candle from both ends and figure out where the best opportunity is.
The ethos of the company, and particularly since Elliott has taken over, is put more a focus back on the athlete. I mean, what's the difference now between what you're doing in this building and say what Bowerman was doing, you know, decades ago and, you know, whatever shack he was working out of?
Honestly, today it's just a more modern, sophisticated incarnation of what Bill Bowerman was doing in his lab. You know, this notion of having an idea on how you might improve an athlete performance or protection, actually building it, you know, Bill Bowerman pouring into a waffle iron, modifying a shoe. That's what this building is designed to do, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka. In its latest earnings release, Nike sprinting forward, driving over 20% sales growth in the category thanks to a redesign of its 3 big running franchises, Vomero, Structure, and Pegasus. The Converse brand, however, a problem area. Sales there, they're declining 28% in the most recent quarter.
Do you worry at all about some of the recent upstarts that have come into this space, particularly on the performance side, Hoka, On Running, Norda, etc.?
But we have 3 incredible brands here at the company. We have Converse, we have Jordan, and we have Nike. So I think a lot of the work that we're doing in this new multi-brand offense that we're in is making sure that we intentionally shape the 3 amazing brands that we have. That allows us to, at certain times, come together to go after an opportunity in the market, but also to be more specific about what each brand represents and the growth potential of each. I think when we think about that, I think it's true. It's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
And we look at innovation not just in product, like Phil's talked about, but how we tell our stories and how we deliver experiences in the marketplace for consumers. And when you think of some of maybe our latest, most innovative marketing concepts, I think back to the last Super Bowl, a male sport at a really important time around the world. And we told the story of So Win through our female athletes, right? We listened to their voice. We're deeply connected to where they were at that moment. And we're able to tell the story of the support of those athletes and what they are doing in the world of sport today. So I think that's one amazing example of we continue to innovate by listening to them where they are, where the world of sport is and sport culture, and then are able to deliver something like So Win.
Amy, I'll give you the last answer here, and this is really on what you want the Nike brand to be, beyond what it already is today.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
Bloomberg's Romain Bostic there at the Nike headquarters. Some people get all the fun jobs, don't they? Well, I hope you're having a happy Christmas Eve. That does it for the opening trade. The Pulse is coming up next. Anna stays on for it. We're looking at the Stock 600 pretty flat right now and US futures pointing south. Stay with us. This is Bloomberg.